difference this time is that because inflation has been so low, central banks have been very patient in terms of raising interest rates. But if inflation does start to pick up, then some of that support will be removed much quicker than markets are perhaps anticipating. We think that actually the inflationary dampening forces that we're seeing are a mixture of cyclical and structural, and there's no doubt that technology has had a large role to play because it allows companies to move away from the domestic market and look at global supply chains. But also we are seeing those cyclical forces which might have contained inflation just beginning to ebb away now. Unemployment's at record lows across many countries. So we do think there will be an uptick in inflation, but actually over the longer term, those structural forces will keep inflation relatively well contained. And subsequently, yes, there will be some increases in interest rates, but they'll be very slow and gradual. There are a number of ways that you can mitigate inflation in terms of investment portfolios. Index-linked bonds or inflation-linked bonds would be the prime example. We also should remember that actually, stock markets themselves don't necessarily mind a bit of inflation because it allows companies to raise prices, hopefully at a faster pace than their costs are rising, and actually earnings can grow. It's all about how quickly inflation does start to accelerate and actually what level it reaches. As long as it's relatively well contained, then actually certainly stock markets should remain relatively well supported.